Fair value of financial instruments, exploring valuation methods and their significance. Agenda items, introduction to financial instruments, concept of fair value, methods of determining fair value, application in different financial instruments, challenges and controversies, future trends in fair value accounting. Definition and types of financial instruments. Equity securities. Equity securities represent ownership in a company, typically in the form of stocks. They provide potential for capital appreciation and dividends. Debt securities. Debt securities are financial instruments that represent borrowed funds that must be repaid. Bonds are a common example, offering fixed returns over time. Derivatives. Derivatives are financial contracts whose value is linked to the price of an underlying asset. They can be used for hedging or speculation. Hybrid instruments. Hybrid instruments combine features of both equity and debt, providing a mix of risk and return characteristics. They can include convertible bonds. Role in financial markets. Capital flow facilitation. Financial instruments play a crucial role in facilitating the flow of capital across markets, enabling investments and economic growth. Risk management tools. Various financial instruments are used for risk management, helping investors hedge against potential losses and uncertainties. Investment opportunities. Financial instruments provide numerous investment opportunities, allowing individuals and institutions to diversify their portfolios and achieve financial goals. Market efficiency and liquidity. Presence of financial instruments is essential for market efficiency and liquidity, enabling participants to transact smoothly and meet their objectives. Importance in investment and trading. Informed investment choices. Understanding financial instruments enables investors to make informed choices and maximize their investment potential. Portfolio diversification. Diverse financial instruments allow investors to spread risk across different asset classes, enhancing portfolio stability. Risk hedging strategies. Financial instruments provide strategies for hedging risks, protecting investments against market fluctuations. Definition and significance of fair value. Understanding fair value. Fair value represents the estimated market price of an asset or liability at a given date, reflecting current market conditions. Importance of fair value. Fair value provides a more accurate depiction of an entity's financial position compared to historical cost methods, influencing investment decisions. Comparison with historical cost. Definition of historical cost. Historical cost refers to the original price paid for an asset at acquisition, providing a static view of asset valuation. Understanding fair value. Fair value incorporates current market conditions and potential future cash flows, making it a dynamic measure of asset valuation. Relevance for stakeholders. Fair value provides a more relevant measure for stakeholders, helping them make informed financial decisions based on current data. Regulatory frameworks and standards. Importance of IFRS and GAAP. IFRS and GAAP are crucial regulatory frameworks that guide the fair value measurement in financial reporting. Guidelines on fair value measurement. These frameworks provide essential guidelines that ensure fair value measurement is consistent and transparent. Transparency in financial reporting. Compliance with these standards is key to achieving transparency and consistency in financial statements. Methods of determining fair value. Market approach. Fair value estimation. The market approach focuses on estimating the fair value by analyzing market prices of similar assets or liabilities. Comparable transactions. It relies heavily on comparable transactions to derive the value of the asset, ensuring relevant market data is utilized. Active market instruments. This approach is best suited for actively traded instruments where market data is readily available for analysis. Income approach. Present value calculation. The income approach focuses on calculating the present value of expected future cash flows from an asset. Income generating assets. This method is especially relevant for assets that generate consistent income, such as bonds and real estate investments. Valuation importance. Understanding the income approach is critical for accurate asset valuation in investment and financial decision making. Cost approach. Definition of cost approach. The cost approach estimates the fair value of an asset by considering the expense to replace or reproduce it minus depreciation. Adjustments for depreciation. This approach adjusts the value for depreciation, reflecting the wear and tear or obsolescence of the asset. Application for unique assets. The cost approach is especially useful for unique or specialized assets that do not have a standard market comparison. Equities and bonds. Fair value concept. Fair value in equities and bonds indicates the current market price influenced by various factors. Market price fluctuations. Market prices for equities and bonds can change due to interest rates and market conditions. Investor sentiment. Investor sentiment impacts market behavior and can significantly affect the value of equities and bonds. Derivatives and structured products. Complex valuation models. Derivatives and structured products require sophisticated valuation models to accurately determine their fair value. Influence of underlying assets. The pricing of derivatives is significantly influenced by the performance of their underlying assets. Market volatility considerations. Market volatility plays a crucial role in pricing derivatives and structured products, impacting their risk and return profile. Commodities and foreign exchange. Supply and demand dynamics. The fair value of commodities and currencies is heavily influenced by the dynamics of supply and demand in the market. Geopolitical factors. Geopolitical events can significantly impact commodity prices and foreign exchange rates, influencing trader decisions. Economic indicators. Economic indicators such as inflation rates, employment statistics, and GDP growth play a crucial role in valuation for traders. Challenges and controversies. Valuation in illiquid markets. Challenges of illiquid markets. Illiquid markets pose unique challenges due to the scarcity of market data, making valuations complex and uncertain. Determining fair value. The absence of frequent transactions complicates the process of determining the fair value of assets, increasing the risk of mispricing. Risk of mispricing. Due to infrequent transactions, there is a significant risk of mispricing assets, which can impact investment decisions. Impacts of market volatility. Effects on fair value estimates. Market volatility can distort fair value estimates, creating a gap between perceived and actual asset values. Increased uncertainty. Heightened market volatility leads to increased uncertainty for investors, making it challenging to assess risks effectively. Impact on asset pricing. Fluctuations in the market can significantly influence asset pricing, affecting investment decisions and strategies. Ethical considerations and transparency. Importance of ethics. Ethical standards are crucial in financial practices to ensure the integrity and reliability of fair value accounting. Transparency in accounting. Transparency is vital in fair value accounting to prevent manipulation and maintain trust with stakeholders. Preventing manipulation. Financial professionals must be vigilant against potential manipulation in valuation practices to uphold ethical standards. Technological advancements in valuation. Artificial intelligence in valuation. Artificial intelligence is transforming valuation methods by providing advanced algorithms for data analysis and predictive modeling. Big data analytics. Big data analytics allows for the processing of large data sets, improving the accuracy and speed of fair value assessments. Timeliness of assessments. Emerging technologies enable timely fair value assessments, ensuring that financial decisions are based on the most current information. Evolution of regulatory standards, continual evolution. Regulatory standards are continuously updated to meet the changing needs of the financial reporting landscape, ensuring and enhancing transparency. The primary goal of modern regulatory standards is to enhance transparency in financial reporting, allowing stakeholders to make informed decisions. Consistency and comparability. Regulatory standards aim to promote consistency and comparability across financial reports, enabling easier analysis and understanding. Integration of environmental, social, and governance ESG factors. Growing trend in ESG. There is an increasing recognition of the importance of integrating ESG factors into business practices and fair value assessments. Stakeholder concerns. Integrating, integrating ESG factors addresses the concerns of stakeholders, reflecting the demand for accountability and sustainability. Valuation alignment. Aligning valuations with sustainability principles enhances the accuracy of assessments and supports long term value creation. Conclusion. Importance of fair value. Fair value is essential for investors to assess the worth of financial instruments accurately, guiding their investment decisions. Methods of determination. Understanding various methods for determining fair value helps analysts provide accurate valuations and recommendations. Applications in finance. Fair value is applied in financial reporting, investment analysis, and risk management, influencing strategic decisions. Challenges and future trends. Recognizing challenges in fair value measurement and anticipating future trends is vital for adapting to market changes. Thank you.